Today we're going to talk about a topic that I've been starting to hear a lot about. It's the 50-year mortgage. And I'm sure you guys have seen stuff over the last few days about this. I wanted to take my time to think about this and let people know what I thought, what my opinions are about the 50-year mortgage. If you don't know who I am, I've been selling real estate in Northern Nevada for over 25 years. Our team in business, has been in business for almost 30 years. And I've seen and heard and watched all sorts of content about the pros and cons about these 50-year mortgages. And will they even happen, to be honest with you? That's a bigger question, is will they even happen, or is this just something, as usual, the government's thrown out there just to sort of distract you from some other news and things on those lines? And so I want to talk today about the pros and cons of the 50-year mortgage. I want to talk how it relates to the 30-year mortgage or even the 15-year mortgage and explain to you what they are. Because at the end of the day, the people that are 100% against it or 100% for it, I don't agree with that, but I do think there's some things you definitely need to be made aware of in order for those to work. So first, let's talk about an average mortgage in the first place. So in my market where I live in my area, let's take a $500,000 home loan. And since rates have been kind of in the sixes for quite a while now, let's use a 6.5% interest rate. And I'm going to show you on an actual loan amortization schedule that I just pulled off of Excel that we can pop up on the screen here. And I want to show you. So if you have a loan for $500 and you have a 50-year mortgage, okay? If you have a 50-year mortgage at 6.5% interest rate, which means you're going to have, it's like 12 times, it's like 600 plus payments over a 50-year time frame. If you do that, your payment would be $2,818.58. And that would be, if you made the same payment every month, just principal and interest. We're not talking about taxes and insurance and HOA fees and all that stuff. We're talking about just the principal and interest portion of that payment. Well, the big part about that, and if you look at this loan amortization schedule, is this. And this is the part when we talk about renting versus owning, where people say, renting's throwing your money away. But what you have to understand is when you buy, that first payment you make, payment number 1 out of 600, the amount of that $2,818 that goes towards principal is literally, and we'll circle it right here for you, $110.25. Now, that is such a small amount of money that forced savings over time is going to take a really long time for you to get somewhere. On top of that, if you literally just made the payment every month for 50 months, you're going to pay almost $1.2 million worth of interest. You'll see it. We'll circle it here on the bottom right-hand side. And then as this amortization schedule goes down, you can see how much each month it would increase versus principal versus interest and how that time frame looks and when the crossover date is to where you're actually paying more towards principal, towards interest. But to me, it just seems like the 50-year mortgage doesn't make sense. Now, let's compare it to a 30-year mortgage. So if you take the same $500,000 loan, the same 6.5% interest rate, and the payment would be $3,160.54, which is $341.76 a month more than the 50-year mortgage. But if you break it down, it's literally $11.39 a day. Now, where the biggest difference is if you look, the principal on the first payment is $452.01. So all the difference in that payment really is being forced savings. It's going right to you. It's not going to the bank. So having that additional, 20 years on your mortgage and having that little bit of a lower payment, to me, just doesn't make sense. The only places I could see having a 50-year mortgage would make sense and only having it for a short amount of time would be if you live in a very expensive area. If you live in LA or parts of California or New York City or areas where, it's almost impossible for a first-time young home buyer to get in to a property, if $300 or $400 a month makes a huge difference in your payment that allows you to get into the property, then great. But it's, to me, a short-term solution because ideally you're going to make more money or you're going to get rid of some of your other debts where now you don't have a car payment or a credit card, and now you could afford to make that bigger payment on your house. But to me, the difference, if you can't afford a home on a 30-year mortgage, I would have a hard time advising you and telling you to go ahead and buy a house on a 50-year mortgage because the pros and cons, they just don't add up. They just don't make sense. And again, if you circle that number, if we go back to our loan amortization schedule on the 30-year, you pay $637,000 some change of total interest versus $1.2 million. So it's just massive numbers. Now, the argument's going to be most people in today's world don't stay in their house for 30 years or 50 years and make that same payment every month for that time frame, which is fair. But at the same time, if the goal of home ownership is to build up some principal, that happens in two ways, or build up some equity, it happens in two ways. One, you're paying the principal portion down, and ideally over time, the value of the property goes up. But if your principal reduction is so tiny that the only way you're going to win is if the value of the house goes up, now you're putting yourself in a very risky situation where if prices were to come down, you could be potentially upside down in the house relatively quickly, which means when you go to sell the house, you might have to actually bring money to the table in order for that property to close. Because if you don't stay there for 5 or 7 or 10 plus years, you just might not build up enough of an equity position to offset the cost of moving and selling your home. So there's some definitely pros and cons here. So let's talk about the 30-year. The pros are, obviously, it's something that we've seen before. You're going to get a lower total interest over the lifetime of the loan. You're going to get more principal reduction every month. You're going to be able to build up your wealth longer term in a better situation, and they're just more predictable. We know what the rates are going to be, which is something we didn't even discuss because typically from a 30-year to a 50-year, we use the same exact interest rate of 6.5%. But in reality, the difference in those interest rates is probably going to be more on the 50-year. Just like if you get a 15-year mortgage, those rates are lower than a 30-year mortgage. So again, this doesn't even take into account the fact that we're probably going to have a higher interest rate on those as well. So again, the cons are you have a little bit of a higher monthly payment and you have more of a drain or more of overhead on your monthly budget. On the 50-year, obviously the pros are lower monthly payment and it makes expensive markets that you could potentially live in potentially a little more affordable for people. But the cons of, huge total interest over the lifetime of the loan, equity buildup being smaller because that principal piece is so tiny, and the fact that we're probably going to have higher interest rates for these, to me, the cons far outweigh the pros. So with all that being said, if you hear these numbers and the biggest thing they're talking about is this is going to make home ownership more affordable, which is the number one problem in our industry right now is home ownership going to be more affordable? And this is not help a home affordability issue. What this does is if 50-year mortgages allow people to be able to now afford a home in an area they couldn't, you're doing what we always do. We're bringing more buyers to the table. You're bringing more demand to the housing market. And the only way you're going to make things more affordable is if there's more inventory. So where are we adding more single-family homes, more multifamily products, more things that people can buy on the market? I know in my market, in many markets, they've made it so cost prohibitive for builders. They've made it so difficult for builders. My son works for a builder and they build, apartment complexes and senior living communities and things like that. And he goes, Dad, the process of the permitting and going through the whole situation, it's so difficult. One of my other clients is building his third home in the area where I live, and he said he would never do it again. It's just so much more difficult and so much more complicated for him to go out and buy a piece of dirt and build his own property that it's just making things more and more challenging. So when you hear these things about this wonderful 50-year mortgage, just know it is not at all cracked up to be. In my personal opinion, especially if you're a younger person, unless you really, really had a nice conversation with someone like myself and figured out what your overall financial picture is, be very, very careful using a 50-year mortgage product. Now, those people that say, hey, if you can borrow money cheaply and turn around and use that money and invest it somewhere else and make a higher rate of return, they're going to keep telling you, hey, mortgage, mortgage, mortgage. I'm not personally a fan of that. I think a more conservative approach, the ability someday to own and have your house, yes, paid for with no mortgage, own it free and clear, and only have, insurance and taxes, property taxes to pay, rather than, always trying to have a house payment. For many people, who definitely don't make tons of money or who never got to the point of being able to buy multi-unit apartment complexes or things like that, where you see a lot of these gurus talking about those things. Be careful when you're leveraging things. I sold real estate back in 2007, 8, 9, and I watched a lot of people ruin themselves financially, start from scratch, go broke, have to start over because they did over leverage themselves and the prices went falling through the floor. And I don't see that happening in today's market, but just be very careful with that. So if you have questions about these, comparing a 50 versus a 30, and if it becomes a real thing with real interest rates, we'll revisit this and give you some more accurate numbers, because for now, we're showing you the differences, and that's with the 50-year mortgage having the same rate as the 30-year, and likely it's not going to. It'll probably be higher. So this number that you're getting towards principal and long-term interest over the life of the loan is even going to be worse than we talked about in our example. So anyway, let me know your thoughts. I'd love to hear your opinions and questions about the 50-year potential mortgage. I don't know how we're really going to see it happen, but I'd be very curious on your thoughts and opinions on it. We'll see what happens, and happy to answer any questions about it.